if the supply had been cut, but the Fed and the other central banks and the monetary authorities had not done a good job of convincing everybody that things were okay and that things were getting better, then prices of commodities still could have fallen, even though supply was falling, because in that case, maybe demand was falling more than supply was, right? But because they convinced everybody that they were going to print enough money to make up for the lack of demand, demand kind of stayed the same or went up a little bit, and supply crashed.
All right, Brent Johnson, welcome to On the Margin. Thanks so much for joining me.
Thanks for having me. Looking forward to it.
Yeah, I was actually looking forward. I thought we were going to be white headphone gang here. We're sans the classic Brent Johnson white headphones.
I still have them here. I occasionally use them, but I decided for interviews that looked a little silly for me to be looking like I was at a rave.
Oh, all right. Well, you think white headphones are silly? Great. As a newly initiated member into the white headphones.
No. It's all good. I love the white headphones. I love the white headphones.
Awesome. Well, we're talking to you here from your new place in none other than Puerto Rico. Congratulations on the move. That's exciting.
Yeah, thank you. Yeah, I've been thinking about it for a number of years, but just a couple months ago, got serious about it, and once we made the decision, it all happened pretty quickly. So I got here about a week ago, and so far so good.
Yeah. Well, I live in New York, so your decision is looking pretty good to me right about now for more reasons than one, let's say.
Yeah, well, there were a number of reasons to kind of make the move from San Francisco. It's I love it. I love San Francisco. California is amazing, but the trend isn't necessarily great. And I've been here in a week. I've met more people in a week who have kind of the same outlook as I do and think about things the same way I do than I did in 20 years in San Francisco. So it's so far so good.
Yeah, I've heard that from a lot of people too. I haven't spent much time / any really in San Francisco, but it seems like it's going through, let's call it a bit of a rough patch right now. So yeah, I think you're on the right side of that trend for sure. Speaking of trends, let's get into it. What I really would love to kind of kick this conversation off with is this topic of inflation. And I still think, we've been talking about this for 4 or 5 months. I still think the question of inflation versus deflation is the most important question that anyone should be asking themselves in finance today. There's been a lot of attention paid to this last CPI print, right, which was pretty high. If you listen to the Fed, they talk about the inflation that we're seeing being transitory. There's a lot of pushback online. What are your thoughts on the latest CPI print? Are we actually headed towards inflation, or is this in fact transitory?
Well, I think a couple things. And first of all, I wouldn't say we're heading towards inflation. I'd say we've had it for a year.
Right.
And people will, first thing I would say is I get labeled as a deflationist because I talk about a stronger dollar. I talk about problems in the banking system. I talk about, this may not last. And so if people want to call me a deflationist, that's fine. I don't necessarily mind it, but I don't necessarily feel like I'm stuck in that camp either. The interesting thing, in my opinion, is that we could actually have a strong dollar and inflation along with it. They don't necessarily, work opposite to each other. But with regard to the CPI, you got to remember the numbers that we're posting now are year-over-year numbers, and the numbers a year ago were just absolutely awful. And I remember a year ago talking to people with regard to equities and saying, I thought equities were going to go higher, and they said, well, how is that possible? And I said, well, in a year from now, the year-over-year comps probably look pretty good because this year is so bad. And it's kind of the same thing with commodities and a number of other inflation indicators. And so we have had people say, Brent, how come you can't see that prices are rising? It's like, I have eyes. I can see that prices are rising. But the question isn't whether prices have risen. The question is whether or not it's sustainable or not. Right. And I am in the camp that says unless a few things happen from here, that it's not sustainable. Now, if those things happen, and we can talk about what some of those things are, then I'm open to the idea of inflation. But I am doubtful those things are going to happen, and so I'm more in the deflation camp than continuous inflation camp. But I feel like I can change my mind pretty quickly on that as well. So anyway, we can talk about that a little bit if you want to.
Yeah, no, absolutely. So what are some of those reasons that would actually make you change your mind and flip to being an inflationista?
Sure. Well, a lot of it has to do with, I think a lot of people think because the Fed has quote unquote printed so much money that there's all this liquidity sloshing around and this prices are going through the roof. And I think that largely the printing of the money has had more of a psychological effect than an actual liquidity effect. And if Jay Powell goes on 60 Minutes and tells you he's printing money, 90% of the people are going to believe him. 99% of the people don't really understand how the monetary system works. And so if he tells you he's printing money, they don't have the knowledge or the expertise to challenge him on it, even if they wanted to. But the biggest part of the inflationary effects that I think that are leading to the inflationary effects are not because we have this runaway growth and money printing and we've got these great prospects going forward, but it's that we're still suffering from the supply chain issues due to COVID. And I don't necessarily think those are going to go away. So, I don't necessarily think that we're going to have a deflationary crash. We certainly could. But I'm not married to that idea. Because I think that these, supply chains have been disrupted, and I don't think that they're going to get repaired overnight. And so I think a large amount of the price rise is due to supply constraints, not necessarily the printing of money or growth concerns. The other thing is that, for sustained inflation to happen, you kind of need to have velocity of money, or for credit to be created and for the money to be circulating, and it just isn't. You look at the bank lending, and it's basically non-existent. It jumped a year ago, after March of 2020. It jumped in April and May. It went up a little bit in June, and then every month since then, it's been falling. And the banks are getting all these reserves from QE, but they're not using them as collateral to then make loans. And if the banks are taking their liquidity and they're parking it in reserves or buying treasury bonds, that tells me that they're not too excited about the economic prospects of anybody that they loan the money to. Pretty sure there's people out there that would borrow the money if they could. Well, not, but in some cases there are, in some cases there's not. But the point is that to really get this lasting inflation and to get this, for the stock market to continue running, to get this kind of runaway inflationary boom, you need to get bank lending to go along with it, because that's who really prints the money. The Fed doesn't print the money. The banks, commercial banks, are who print 90% of the money. And right now they are not printing it. I mean, and maybe they will. And if they start printing it, then, I will say, hey, now they're doing it. Now we need to think about it. But as of right now, they're not doing it.
Yeah, absolutely. So you just kind of outlined the three key debates there, or kind of components to focus on, which is one, kind of supply side versus demand side inflation. Two, there's kind of this liquidity problem. And then three, there's just good old fashioned bank lending, which is how broad money supply growth actually happens. And we're just not seeing that. Right. So let's talk about liquidity a little bit. So we had Steve Van Meter on this podcast last week, which actually just came out today. We're recording on May 26th. And, basically his contention was QE as a monetary program is largely actually very misunderstood. You kind of see those memes where it's like money printer go burr, right? Look at all this money that we're creating. But in reality, it doesn't quite work like that. And that the program is actually designed to strengthen the dollar while lowering interest rates. And that doesn't necessarily create liquidity at all. So what's your kind of perspective on QE as a program, and why might that not actually be as inflationary as some people think?
Well, I think it's kind of somewhat related to the bank lending. Again, the idea is that you pull interest rates down. It allows there to be a smaller hurdle rate for people to go out, borrow money, and then invest it in an economic project or some kind of a program that exceeds that hurdle rate, right? But the loans aren't happening. And again, we're kind of going back to the same thing. That money isn't being borrowed the way it was, and the banks aren't lending money the way they were. Lending standards are high. You'd think
Right.
if they had all this liquidity, that they would be excited to make loans, but they're not. Bank lending standards are very high. In other words, it's the meme is that there's all this liquidity out there, and to some extent, maybe there is, but the idea that all you have to do is walk outside, hold up your hand, and it's easy to get a loan is just simply not true. Because the banks are not making loans, and they're making the lending standards to get a loan very high. I'll give you an example. We have a client whose family has been developing real estate since the 60s, so 60 years, on the West Coast and throughout the Midwest. And they are one of Wells Fargo's biggest clients. the value of the value of the debts that they have, the loans that they have, versus the value of their property is like 10 or 15%. So pretty low. You know, they're not highly leveraged at all. And Wells Fargo does not want to give them any more loans to go do any more projects. Now, if this is one of your best customers and you've been doing business with them for 60 years, and they have a debt ratio of like 10 or 15%, you would think that in this environment you'd be excited to make them a loan, you know, in this booming economy that we have, but they don't. So if that family's having trouble getting a loan, or they'll get the loan, but they're at terms that they just think are completely unrealistic and unfavorable. So my point is if that family's having trouble getting a loan, you know, imagine what the average person out there, how they're having to do it. So I think that is a big part of what's happening. And you know, so QE, while in theory it's supposed to provide all this liquidity, it's like the quarterback handing it off to the running back. So the Fed is the quarterback, and the Fed, you know, calls the ball, and the center snaps it to them, and they turn around and they hand the ball to the running back. But the running back ain't running. The running back's just kind of sitting there, and he'll down it because he doesn't want to lose any yards. It's like he doesn't want to lose any yards. He doesn't care if he makes any yards. He just doesn't want to lose any yards. And so he grabs the ball and he sits down. And I don't know if that's a good analogy or not, but for QE to really drive economic growth, inflation, and you know, general prosperity, there needs to be a partnership between the central bank and the commercial banks. And right now, they're not working together.
So why is that, right? Because my understanding of QE is you're injecting liquidity into the system. You're basically doing this asset swap, which is primarily between, you know, treasury securities, MBS, that kind of stuff. You're putting more reserves into the banking system. Theoretically, that should encourage the commercial banking system to actually lend and create broad money supply. Why is that not happening?
The biggest problem I see is, number one, there's a misunderstanding of what bank reserves are and what they're not. And without getting into the whole debate again, bank reserves are basically an accounting entry. They're not the same as cash. The banks can't just take these reserves that they get as a result of QE and go do whatever they want with it. They can use it within the banking system, but they can't pay salaries. They can't go invest in a project. It's not cash. Anyway. So that's part of the problem. And then the other reason that it's not happening is banks are in the business of lending money and getting their money back, right? And despite interest rates being low, you know, so interest rates being low, they have a hurdle rate as well, right? They only want to lend to projects that are going to exceed the risk of their capital being out there. And if they don't think that the project that they're going to fund is going to return them a higher level than their cost of capital, and that they're going to get paid back in the end, they don't want to make the loan. And so that tells me if banks aren't lending, we have this amazing economy apparently, right? You know, employment's on the rise, stock markets are at the all-time high, inflationary pressures are picking up, and you know, there's a housing shortage, all this kind of stuff. Well, you would think that the banks would be excited to make loans, but they're not, because they don't think they're going to get their money back. It's just like you or I. I don't want to make a loan to somebody that's not going to pay me back, and the banks don't want to make a loan to somebody that's not going to pay them back. And so all of this reserves that the Fed is giving to the banks just clog up the banking system. And the problem now is that there's so many reserves in the banking system, the banks are out there just parking them in T-bills and bonds and stuff, that it's actually pushing interest rates down. So the market, the banks are saying, we want negative interest rates. We want to hold on to these reserves so bad, and we want to buy bonds so bad that rates are going negative, or short-term rates are going negative. And so the Fed has actually been pulling some of these reserves out of the system, draining liquidity in order to keep the price of to keep interest rates positive. So on the one hand, we're supposedly having this booming economy, you know, employment's picking up, stock markets are rising, profits are rising. But on the other hand, banks don't want to make any loans, and interest rates are about ready to go negative. So, you know, which side are you going to bet on? Now, there's a lot of people betting that the inflation is going to continue, and that the growth is going to continue, and that this global reflation is going to happen, and you know, we're going to allocate to emerging markets because that's where all the growth is. But on the other hand, the banks are saying that ain't true. We're not on board. So one of those sides is going to win. Now, I happen to think that the banks are going to win in the short term. Now they might not, and if they don't, people hear me talk about the dollar a lot, and the reason I talk about the dollar is I think it's the single biggest risk to global markets. Now that doesn't necessarily mean that that risk is going to materialize. I think it's going to, but I don't have 100% of my money bet on it. But because I think it is such a high risk, and if it does happen, it is so detrimental and it can be so egregiously negative, I have to at least plan for it. And so that's what I think is going on. Is I think the Fed has done and the central banks around the world have done a good job of convincing people that they have everything under control. They've flushed the system with reserves, and that has convinced people that they're printing money. And so people have gone out and put their money into investments that push inflationary indicators higher. But I'm not convinced it's going to last, and the banks aren't convinced it's going to last either. And so, typically the banks end up being right. Now they're not always right, and so maybe this time they'll be wrong. But I'd lean towards the banks being right.
Yeah. So before we kind of get into the dollar, because I know, especially when you're talking inflation versus deflation, really all roads lead back to the US dollar. I do want to at least get into this idea of like kind of the supply versus demand driven inflation, right? All of us kind of watched what was sort of a meme, right? With that ship getting stuck in the Suez Canal, right? That deflected almost a comically large amount of global trade, right? Through that one route. And people said you were going to see backups and all that kind of stuff. And I think there really is a big difference in between kind of supply chains, production coming back online, can't meet demand quickly enough, versus this other type of demand, longer lasting sort of inflation. So how do you think about those two different types of inflation in your mind, and what makes you think that we're seeing kind of a supply driven inflation right now?
I think it is mainly supply driven because, for example, copper. I a year ago, I wouldn't have been surprised to see copper go much lower than it had been. But it's a combination of two things. If the supply had been cut, but the Fed and the other central banks and the monetary authorities had not done a good job of convincing everybody that things were okay and that things were getting better, then prices of commodities still could have fallen even though supply was falling, because in that case maybe demand was falling more than supply was, right? But because they were able to convince everybody that they had everything in control, and because they convinced everybody that they were going to print enough money to make up for the lack of demand, demand kind of stayed the same or went up a little bit, and supply crashed. So in that environment, when you have demand stay flat and supply crash, price rises, right? So I understand exactly why prices have gone up. The question is whether or not the monetary authorities can continue to convince people that demand is going to stay the same, right? Or that demand is going to grow. Maybe they can. I'm not convinced that they can, and the banks certainly aren't printing. Like we talked about earlier, for this really to continue, we need the banks to increase the supply of money, and they're not doing it. So in my mind, the central banks have to continue convincing people that it can last. And the central banks are actually out there telling you it's not going to last. The central banks are actually out there telling you it's transitory. And I'm no fan of central bankers, and I actually hate the fact that I actually sort of agree with them on the transitory stuff here. But the fact is if we think about where prices were a year ago, think about where they were 15 months ago, 16 months ago before COVID. They were at this level. And then we went into COVID and they went here. And then they went up like this, right? So now we're here. Now let's fast forward 12 months. So we have the base effects from being way down here to way up here. So that's what's making the inflation look so high. You're going off a very low base. If you took where prices are now based on where they were at the beginning of last year rather than at the lows in March or April, prices would still be high, but not nearly as much as the CPI is showing year over year for 12 months. But now let's fast forward 12 months and let's see where we are 12 months from now. Because now we're here. Now this is the base, right? So are we going to go there?
Right.
Or are we going to come down? Because we could come down, still be higher than where we were 15 months ago, but year over year, it's going to look bad. It's going to look like we're going back into deflation, right? And so that's part of my reasoning for saying that I'm not convinced that this is not transitory. I'm not convinced this is sustainable. I'm open to the idea of it being sustainable, but I just don't think it is. And I think the evidence, the historical evidence, I think is on my side. But I can be wrong. We'll see. But I've got positions out there that will be fine regardless of what happens. But I am leaning towards it being transitory.
Yeah, I agree. I also, I do listen to, I'm kind of a student of, Lacey Hunt, David Rosenberg as well, who are kind of some of the prominent, if you want to label them like this, deflationists. And I think there are a couple, much broader kind of macro topics that people don't factor in as much here, right? Which is one, demographics, right? Where the demographics not only in the U.S. but also in Asia, right? Whose labor force we've essentially sequestered, for U.S. production, they're massively deflationary. And then the other thing is, if you look at debt to GDP, I know, look, I get the arguments where, hey, one person's debt is another person's asset, but at a certain point, there's too much debt, right? And for those who are kind of pointing towards, hey, look at 1940s, look at 1970s, look at the inflation that happened then. Even if there is inflation, we are not going to see 1940 style and 1970 style interest rate hikes. That's just not possible, right? So I guess even in a situation where inflation persists and it's more than transitory, I mean, you kind of end up in a regime of financial repression at that stage, right? Because even if inflation is going, they've got no choice but to keep the interest rates low. I don't know if you agree or disagree with any of that.
Yeah, I mean, at the end of the day, we are in financial repression, or they are attempting financial repression. They are and when I say they, I mean monetary authorities, governments, bureaucrats around. And it's not just the U.S., it's around the world. I mean, they are attempting to get real rates low, right? They're trying to get it to where the inflation rate is higher than the interest rate. And so that over time, their debts become easier to service. And this is not a new phenomenon. This is as old as time. This is the playbook. Human nature never changes, and that's why history kind of cycles over and over and over. It's people, no matter how many times that they learn that leverage is a killer, people lever up, and then even though they try to be responsible, at some point they've just borrowed too much, and politicians, the way they get elected is that they promise things, and the way that they pay for these promises is that they borrow money, and so you inevitably get to this point where the debts either have to get paid off, or the debts have to get satisfied either by crashing and the loan going bad, or you have to inflate the debt away. And of course they don't want deflation and the loans to not get paid, because that creates all kinds of problems. So the standard playbook is to generate inflation. And so it's funny because people will tell me this all the time. They say, Brent, don't you get it? This is going to be financial repression. They're going to generate inflation higher than the interest rate. And I always got, I was like, of course yes, I get it. I completely get it. Just because they want it doesn't mean it's going to happen, right? Maybe it will. Maybe they'll be successful. But I would say that they've been trying to do this for 15 years. Well, they've been trying to do it for 12 years in the U.S. They've been trying to do it longer than that in Europe, and they've been trying to do it for 25 years in Japan. Now, maybe they figured it out this time. Maybe now in 2021, they figured it out. Maybe. And if that's true, then I'll have to get on board. But so far, I'm not convinced that they figured it out. So again, just because something needs to happen or they want something to happen doesn't mean that it will. This kind of goes back to, I talk about all the time when you're allocating money. There's certain things that I would like to see happen, and then there's other things that I think that are actually going to happen, right? And I try not to invest based on what I want to see happen. I try to take my emotion out of it and place capital based on what I think is actually going to happen, regardless of whether I want it to or not. And so that I think a lot of that stuff is kind of permeating the markets right now. People, investing for what they want to see happen rather than what's actually going to happen.
Right. And one thing that I think was funny, there's a book that gets talked about a lot in kind of macro circles, Market Wizards, this Jack Schwager book. Where he interviews kind of like Bruce Kovner and Paul Tudor Jones and everything. These interviews are taking place in the late 90s, like might be 89, something like that.
Yeah.
And if you listen to these interviews with these very prominent hedge fund managers, they're saying the same stuff that we're saying right now, but it's much smaller numbers, right? They're saying, you know, the deficit last year was 75 billion.
Well,
Inflation is right around the corner. And, you know, it's hard because sometimes if you don't have that perspective, you know, I kind of listen and take it for face value. What a lot of these people say, and it's like, you've been saying this for 40 years, man. You know, at a certain point, like, you were either wrong because you're too early, or there was something fundamentally flawed about the analysis, and you need something different to create inflation than just a budget deficit. I don't know. But I think, you know, when it comes to predicting inflation, like, I know it's hard to call the catalyst or the trigger point or whatever it is, but there has to be more analysis, I think, than just we're running a big deficit. And I get it, there's twin deficits, I get it, but I'm kind of on your page. I think, you know, to make an informed call about that, you have to point to what's different this time. So I guess my last big question for you on this topic of inflation versus deflation, how transitory is this really, before we move on to the US dollar, is, I guess one of the things, you know, what Lacey Hunt always says is, when the liabilities of central banks become legal tender, that's when we're likely to see inflation. And I'm wondering, you know, Lynn Alden talks a lot about this kind of transition that we're seeing finally from monetary into fiscal, right? Where you're not seeing the central bank just printing these reserves or this kind of base money, but you're seeing real broad money injection, right, into the real economy. I'm curious, does that change your mind at all about what we're talking about, especially because, you know, we've seen deflation for so long that if that channel of money creation were to persist, maybe we could actually see lasting inflation there?
Yes and no. It can last for a while. It can last as long as the people believe that what the government's telling them. So, you know, can it last another year? Sure. Can it last 18 months? Yeah, probably. But here's the thing: is with fiscal spending, when governments spend money, everybody says, "Oh, the government's spending money now. We're going to have inflation." Well, as far as I can tell, the governments have been spending money for hundreds of years. This is not a new phenomenon. You know, we've been running trillion-dollar deficits for a decade. This is, you know, so we're adding a couple $100 billion now, or even another trillion to it. Now, all of a sudden, that's inflationary. Well, maybe, but what people forget is, how is that money that they're spending being funded? So what I mean by that is, and this is important for people to understand who are perhaps new to, you know, finance or the monetary system, is that there's a difference between securitized debt and bank debt. And treasury bonds are securitized debt. It's not bank debt. So what I mean by that is, when a company or an individual, or when a Treasury Department, such as the U.S. Treasury, sells bonds, they issue bonds and they take cash out of the market. You know, people in the market buy those bonds. So that money that the bonds, that the treasuries are being bought with, is money that already exists. It's not, they're not printing new money to buy the bonds. It's money that already, so it's recycling money that already exists. And the recycling of the money can have a flow effect that can actually help, you know, the greasing of the economy and the flow of capital. But it's kind of like if you had a still pond, right? And it's just totally still, and you threw a rock in it. You're gonna, and it's gonna make a splash, and the ripples are gonna go out across the pond. But 5 minutes later, it's gonna be flat again, right? So there was some flow there for a while, you know, the ripples from that splash, but eventually that pond is gonna go still again. And in order to get it flowing again, you need to throw another rock into it. So securitized debt is a little bit like that. It's recycling, it's swirling the water that already exists. It's not throwing more water into the pond. It's just making the water that exists in the pond circulate. But when you have securitized debt, when a bank lends money, when you go down to the bank and you say, I need, you know, $250,000 for that condo in Oklahoma City or whatever it is, they create that money out of thin air. Boom. That's new money. Now they're throwing new water into the pond, right? That's not just circulating the existing money. And so that's why, you know, that kind of goes back to my point earlier about, you know, inflation versus deflation. Is, so far, the Fed keeps throwing rocks into the pond, but the banks aren't throwing water into the pond, right? And so, you know, that kind of gets back to is fiscal spending inflationary? And in the short term, it has inflationary effects. And I won't sit here and say it doesn't have inflationary effects. The debate is not whether this stuff is inflationary. The debate is whether it is lasting, whether it can continue, whether it's sustainable, right? And my argument is that without the banks helping them, it's not sustainable. Yeah, and I wish I had a crystal ball that I knew exactly when it would end, or it would last exactly 24 months. I don't know exactly, but I think that if they're not able to get the banking system to cooperate with them, the Fed is basically pushing on a string, for lack of a better word.
All right, so let's transition over and start talking about the dollar a little bit. You mentioned actually earlier in this interview, and I've heard you say this as well, that a strong dollar is actually a big threat to the global financial system, right, and kind of against everyone's interest. Why do you think that?
Whenever the inflation-deflation debate comes up, it often then also goes to fiat money versus hard money, gold, Bitcoin, some kind of a commodity money that's not printable, that's stable. We used to be on a gold standard, and the gold standard, kind of regulated the amount of capital that could be allocated and the amount of debt that could be issued, and it kind of kept governments honest of how much money they could spend. But we all know that in the early 1970s, Nixon severed the link between the dollar and gold, and so that kind of freed them up to spend as much as they want. And you just go to a number of different charts, and you just see it go exponential since the early 1970s. But the reality is now we have the same system, the global system, except for a different thing is underlying the system. So whereas gold used to underlie the system, now dollars underlie the system. And the dollar is the collateral off of which the entire global economy is levered. We're getting into this situation where there is so many debts in the world, and not just euro. So as an example, there's a lot, everybody talks about it's getting close to 28, 29 trillion now that the U.S. owes. I don't even know what the latest number is. It seems like it goes up, every month quite a bit. But and they always talk about what a big problem this is, and it is. It's a huge problem. But what people don't realize is that there's that many loans denominated in dollars outside the United States that non-U.S. entities owe, and so they have to get dollars somehow. And those countries and those entities, they can't print dollars. Can the U.S. print dollars? Yeah, the U.S. can quote unquote print dollars, but those other countries can't. So in the same way that years ago you couldn't print gold to help satisfy your debts, the rest of the world is in that same situation with the dollar. They can't print dollars to satisfy their debts, and they have a lot of debts, a lot of dollar debts. And if the money is not circulating, and if credit, this kind of goes back to bank credit again. If credit isn't being extended, the dollars needed to service, forget paying it off, just to service the dollar debt, it makes those entities having to scramble to get dollars just to service their debt. If the dollar gets stronger versus a foreign currency, that makes it even hard. It takes even more. Let's just use Australian dollars as an example. It would take even more Australian dollars to buy U.S. dollars to service their debt. Now, Australia doesn't actually have that huge of a U.S. dollar debt, but I just use that as an example. But places like Turkey have a ton. Places, a number of African countries, a number of Asian countries, a number of emerging market countries have huge U.S. dollar debts. And the reason that these countries have taken out dollar debts is because there's so much demand for dollars versus their own currency that if they issue debt, they get a lower rate. So, you can issue dollar debt, and I'm just going to make up a number, you pay 3% or 4%. And if you issue local debt, you pay 7% or 8%. Well, most of the goods that they sell, they're getting dollars for goods, so it makes it very easy for them to, issue dollar debt and then take the dollars that they get for selling their goods and service the dollar debt, and it's cheaper. The problem is that if you get into a situation where your economy is slowing down and you're having to print more money in your local economy, then your local currency starts to fall, and it makes it even harder to buy those dollars on the open market to service your debt. So it eventually becomes this vicious cycle where everybody scrambles for the dollar debt. The other thing that makes it hard is that I think that we're getting into this era of this Triffin's dilemma where, so there's this, it goes back a number of years, right. I think 60 years ago, this guy came up with Triffin's dilemma, which said, when you have a global reserve currency, when one country's currency focuses or serves as the global reserve currency, at some point in the future, the needs of the domestic economy are going to come into conflict with the global economy. And Trump is no longer in power or as a president, but I think one thing that he did was I think that he did a good job of explaining or showing the country and that perhaps what we had been doing for the last 30 or 40 or 50 years regarding manufacturing or where our trade deals, perhaps were not in the best interest of the United States. And so we've kind of had this kind of nationalistic movement, for lack of a better word, in the U.S., and we've seen these nationalistic movements around the world, in other countries as well. And so these nationalistic movements, these are the opposite of global cooperation, right? It's like focusing on the domestic rather than focusing on the globe. And so, I think that we're going to end up in this era where, while the U.S. has to focus on domestic issues, they're not as willing to bail out or serve the rest of the world. And that becomes a problem because the rest of the world needs dollars. And until a new system is designed, there is no other game in town. It's the dollar. And so I continue to think that we are going to, as a result of all the debt in the world, to your point earlier, you said eventually the debt matters, right? I think that we're going to have a global debt crisis. And when we have the global debt crisis, I think it will spill over into becoming a currency crisis. And when we come into the currency crisis, that's when I think the dollar rallies. So that hasn't happened yet. So I thought, going back to 2018 and 2019, I started talking about the coming currency crisis, the coming sovereign debt crisis. I thought we would have already been in it by now. And part of the reason I thought that we would be in it by now is because I thought countries would stop cooperating and just kind of, go it alone, so to speak. I think what happened with COVID, I initially thought it was accelerating it, but in hindsight, I was wrong. And I think what COVID was so big and so severe, it forced everybody to kind of work together. And when they work together, they can extend the game. And so I think COVID actually extended the game. And so we haven't entered this currency crisis yet. So I think when we get into this currency crisis, I think you're going to see the dollar go a lot higher. And I think it's going to become kind of this vicious loop where dollar strength begets more dollar strength, and other countries' weakness it begets more currency weakness. So it hasn't happened yet. So I've been early, and it's funny in this business. People say, "Well, Brent, why can't you just admit you're wrong?" It's like, I'm wrong. I've admitted this several times. I thought it would have happened already, and it hasn't. Now the question is does it still happen? I don't know. I think it's likely to happen, and I think, again, like I said earlier, I think the ramifications of it happening are so severe that I'm not willing to do nothing and wait for it to happen. I think it's important to have some protections against that. And so I still think that that's coming. And again, whether it happens later this year or a year from now or 18 months, 2 years, I don't know. I wish I had a crystal ball, but I do still think it's coming.
Yeah, absolutely. I mean, timing is really tough, right? And I mean, even if you look at 2008, the great financial crisis, there were plenty of folks, right, that actually made that bet just early, right? Like starting in 2005.
Yeah. Right.
And they kind of just made that bet earlier than kind of like the Mark Harts, of the world who eventually got the timing right. But just because you got the timing wrong doesn't mean that in principle, from a first principle standpoint, you were wrong. And I think the way you frame this as, when we go through global crises, the most likely next one being a global debt crisis, there's a big squeeze in terms of dollars, right? Because everyone needs to get their hands on dollars. All the debt is denominated in dollars. And when you really think about it, we used to go through these problems when gold was the reserve currency of the world as well. And one of the big problems that we were trying to solve by moving to this fiat system is that there was no way to allow for a demand function, right? That the needs of the currency kind of needs to conform, at least in some way, to the needs of the economy. But the way that it's structured right now is that all these debts are denominated in U.S. dollars. The main flow of real U.S. dollar broad money creation is the U.S. banks, and they're not lending. So essentially, there's this structural problem. For whatever reason, our banking system is not providing them. And the rest of the world needs these dollars. So what you're starting to see is actually these offshore originators of the system that originates dollar-based debt, which is the Eurodollar system, which is, let's just call it a pretty complicated beast. But how does in your mind kind of the Eurodollar system? First of all, can you just give us an overview of what is it and how does it kind of factor into everything that you're talking about right now?
So I'll keep it pretty simple because it can become endlessly complicated. I mean, on the one hand, it's super simple, and on the other hand, it's you can go as far down the rabbit hole as you want, and it can be extremely complicated. But essentially, think of it like this. You've got the dollar market, you've got a yen market, you've got a Brazilian real market, you've got a euro market. So you've got all these different currency markets, right? And they all correspond to that country. But then in addition to all of the individual domestic markets and the currencies associated with them, you have another market called the euro dollar market, which is not euros. It's completely different than euros. It's dollars that exist outside the United States. And that market is bigger than the market for dollars inside the United States. So not only is there a big market for dollars inside the United States, which dwarfs the markets of all the other currencies, but there's an even bigger dollar market outside the United States. And it is non-regulated, it is non-measurable, it is endlessly complicated, but it all exists on the extension of dollar credit. And as long as that dollar credit outside the banking system, outside the United States, is being extended, the global economy runs. But when that starts to contract and that euro dollar market lacks funding, or people in that euro dollar market cannot get euro dollars to satisfy their euro dollar loans, really, really bad things happen. 2008 was largely, it started as a result of the housing crisis, but it became a euro dollar issue as funding of dollars became harder and harder to get. And it's what led to in the spring or in the fall of 2019, we had the euro or the repo spike, and then it manifested itself in a very large way last year in March of 2020. And it's and it's because there's so much demand for dollars. But the reason that it becomes a problem is there is the Fed oversees the U.S. domestic dollar market, and the ECB oversees the euro market, and the Bank of Japan oversees the yen market. And if you understand the way the system is designed, there's base money, and then the base money is used to loan new money into existence. And we go back to our pond. As long as the flow is high enough in that pond, that system is fine. But if the flow stops, that central bank has to come in and throw more water into the pond, like what we were talking about earlier. The problem is with the euro dollar market, there is no central bank overseeing it to come along and recollateralize it. There's no central bank to come on and throw more water in the pond when the liquidity starts to drain out of it. And so that's what you see. And so one of the ways that market does get extra liquidity is either, like you said, bank extensions, either from the U.S. to outside the world, or the extension of dollar credit by entities outside the U.S., or what they did last year was they did swap lines. So the Fed loaned money to the other central banks, who then loaned money to their entities that needed dollar financing. But the point is that when that flow stops, really bad things happen, and they happen really, really quickly. And I've had several people over the last year who have said, Brent, the dollar's been going down for a year now. How can you not see this? How can you not acknowledge it? And I just have, of course I see it. The dollar's down 10% in the last 13 months. Do you really think I can't see this? And the point is that when this happens, so then they're like, well, why don't you give up on the trade then? And then I say, well, first of all, you make this sound as like this is the only thing I'm invested in, which is completely not the case. My point is that this is such an important issue, you should have a portion of your portfolio allocated to it in case it does manifest itself. And I think it is going to manifest itself. So I can't just ignore it. And then they'll say, well, why don't you just wait until the dollar starts to go up again? And I say, well, I don't have a crystal ball. I don't know the exact timing. But what I do know is that on February 28th of last year, of 2020, the dollar was like 97 or 98. 10 days later, it was at 94, and everybody said the dollar's going to crash. And 10 days later, it was at 103, and the world was on its knees begging for dollars. So all of that happened in a 3-week period. Now, I have an ego, but my ego isn't big enough to think that I can time that perfectly. I wish I could, but I can't. And because I think this is going to play out in the next 3 or 4 years, I'm prepared to keep a position for the next 3 or 4 years in case it does. Because I think that this is the single biggest risk to the market, this euro dollar market and dollar shortage. And I know people have a hard time comprehending this dollar shortage when the Fed is quote unquote printing every month. But my point is that it can come out of nowhere and it can overwhelm. And the numbers that the Fed has quote unquote printed so far are nowhere near enough to satisfy it if that euro dollar system crashes. The euro dollar system dwarfs the US dollar system. And so I think the problem is just much bigger than anybody can comprehend.
Yeah, absolutely. So let's just like kind of take some of this theory and like actually, put it into real world use cases. Like, what does a strong dollar mean? Because sometimes when I think about this, I'm like, okay, I could see how a strong dollar is actually bullish for stocks, right? Because strong dollar means you're attracting capital inside of the United States that should theoretically pump, U.S. denominated assets. Okay, that's good. I could also, though, see how a strong dollar is actually bad for something like U.S. equities, because that makes our exports less competitive overall. If you think about it from a high-level standpoint, if you think about stocks being denominated in dollars, stronger dollar equal, less of them, less of them being worth stocks. So is a strong dollar, is it good or bad? I mean, how do you think about this from an asset standpoint?
First thing I would say is that within a band, it doesn't really matter. Let's call it 80 to 95, like that 15%, or 85 to 95, it doesn't really matter, right? I think the whole world would love it if the Fed could take the dollar to 80 and just hold it there for 10 years. I think everybody would love it. All the central banks would love it. Well, Europe and Japan might not love that the euro and the yen, appreciated another 10%, because I think that would then hurt their exports. But they need to keep the dollar at a level where there's not stress in the funding markets, and there's enough dollars that you don't have to scramble to get them. And if let's just say the dollar was at 94 or 95, and that was indicating that it was kind of strong but not super strong, I think that would be indication that capital's flowing to the U.S. It's one of the more promising looking sectors of the globe, and that that's not necessarily bad for stocks and not necessarily bad for businesses, and equity prices could rise. Maybe if you get from, and then it kind of depends on the speed with which it's happening, right? And you could probably even go to 97, 98. If it was just got a slow, steady grind, probably not a big deal. But if it goes from 94 to 104 in a week or in 10 days like it did in 2020, that's a problem, because that's an indication of you're getting a short squeeze, right? The dollars are so, and in that environment, initially, that's actually bad for U.S. stocks, right? Because now everybody's not just the euro dollar market, but even in the U.S. market, they're scrambling for dollars. And so, in that environment, that's maybe bad for stocks. Where I have said that we could get a situation where the dollar is rising really fast and really hard, and U.S. equities are going with it, that is a result of entering a debt crisis, a sovereign debt crisis. And if the sovereign debt crisis happens, that means that the price of sovereign bonds is falling. And the sovereign bond market, other than the currency market, it's the biggest market in the world. So if now money is flowing out of sovereign bonds, it's got to go somewhere. And I think one of the only places that it can go, that's a big enough market to handle those flows, is U.S. equities. And then I think that if someone in Brazil is trying to decide, do I own a Brazilian bond that pays me 7%? Or do I buy, Coca-Cola, which pays me 4%? And if the currency of the dollar is going up versus the real, maybe I just go buy Coca-Cola, right? I use that as an example. And so in that environment where you're having a global sovereign crisis and capital is looking for the safe harbor, again, people say, the U.S. is not looking so good. I don't know how you can say it's a safe harbor. Again, it's all relative.
Right.
Pension funds do not have the opportunity to just sell everything and go sit in cash. Pension funds cannot sell everything and go buy gold. Or pension funds cannot sell everything and go buy Bitcoin, right? They're going to allocate most of their money to a major asset class. Now, that doesn't mean that they're not going to increase their cash holdings. It doesn't mean that they're not going to increase their gold holdings. It doesn't mean that they won't start to buy some Bitcoin. But they're not going to sell 100% of their portfolio and put it all into gold or Bitcoin. So that means that capital, as it's leaving sovereign bonds, it's going to look for a big market, liquid market, And one of the biggest, most liquid markets that I think can sustain those flows is the U.S. equities. And so that's why I think, under normal circumstances, the dollar going to 120 or 130 it's just a disaster, right? And I'm not saying that it would still be a disaster for the U.S. And we got to remember, if we get into a situation where the dollar's going to 120 or 130 and U.S. equities are going with it, it's not necessarily a good thing, because the world is a really bad place if that's happening. And I think that's another thing that people, kind of mistake, is that they think that I say that the U.S. is just going to be this boom and it's going to be a beautiful place to be. I don't think that at all. I think it's going to be really hard, but I think it's going to be better here than elsewhere. And I think capital will be treated better here than it will be elsewhere.
If you see us heading towards kind of a sovereign debt crisis, then, I mean, do you think that we are going to eventually enter financial repression, and then theoretically like gold and Bitcoin and those sorts of store of value assets should perform well, or do you not see us entering financial repression?
No, I do. I think that we will. Well, it kind of goes back to Lacey Hunt's. You mentioned this earlier, that it's you have all these policies, and eventually there's an asymmetric response, right? And I think, I don't want to switch gears and go too far back there, but and I'm certainly not going to speak for Lacey, because nobody can speak for Lacey better than himself. But I think what Lacey's getting at is that QE, other than the psychological aspects of QE, which says, hey, we're printing money, go change your behavior, which does work for a while. And as Steve Van Meter pointed out, QE is largely negative. It's largely deflationary, right? And so they do QE, they do QE, they do QE, they get a little bit of a run and then it falls over. They get a little bit of a run and then it falls over. And so then they do another policy and it gets a little bit. Finally, they're so desperate that they make the bank reserves legal tender. And then you get the asymmetric response. It's like a ratchet. It's like it gets tighter and tighter and tighter. The monetary policy gets tighter and tighter and tighter. And then finally, they make the bank reserves legal tender. Now it's just free to do whatever they want. And boom, then you get the just super runaway inflation, right? And I think that's probably what will happen. Governments around the world, central banks around the world will continue to do QE programs. They'll continue to, they'll do UBI, they'll do loan forbearance, all of this stuff. And eventually there will be no other choice but, make the bank reserves legal tender, and then we'll get the hyperinflation. Now, I think this is probably a good point to bring up, that you can have inflation and deflation at the same time. In the one hand, you can have stagflation, which means in one market, you can have some assets inflating and other assets deflating. So that's stagflationary effects. But the other thing that you can have is you can have inflation in one currency and deflation in another. And this is the key that I think people need to think about. It doesn't so much affect us in the United States because we only use dollars. Very few Americans take out euro loans. Very few Americans take out loans in Brazilian reals. I'm not saying it doesn't happen, but this is not a, and very few businesses do either, right? It's just not the common occurrence. But there's a ton of, as we talked about earlier with the euro dollar market, the rest of the world absolutely takes out dollar loans. And even if they don't take out dollar loans, everywhere in the world knows what the dollar exchange rate is. You fly to Morocco and go to a souk in Marrakesh, they will tell you what the dollar exchange rate is. You go to the beaches in Rio de Janeiro, you grab anybody on the beach, they will tell you what the dollar exchange rate is. Same thing in Singapore, same thing in Hong Kong, same thing in Africa. It's just the way it is because the dollar is so important. But if you walk down the street in New York City, grab a Lincoln, Nebraska, you ask them what the exchange rate with the Brazilian real is, they're going to look at you like you got two heads. They have no idea, right? And so this is an example where let's just use Argentina as an example because it's always such a disaster monetarily anyway, but they can have runaway inflation in Argentinian peso terms, but have deflationary effects in dollar terms. Venezuela is a perfect example. We'll use Venezuela. You go and you look at the stock market of Venezuela over the last 10 years in Venezuelan Bolivar terms, stock market went through the roof, right? Because the currency lost value. But look at that same stock market in US dollar terms and it crashed. And the reason this is important is the rest of the world uses dollars. So, I think when you're talking about inflation, the first thing you need to understand is which currency are you talking about? If you're talking about the dollar, or are you talking about the local currency? And because I think there's such high demand for dollars relative to other currencies, as we move forward in time, even though the US is quote unquote printing, so is the rest of the world, but there's less demand for their currencies. And as we get into this debt crisis, and listen, maybe it'll never come. I think debt has consequences. I think we will get into it. And when that happens, I think these other countries will have to print even more than the US is, and we'll have to do even more of these stimulus programs than the US is. And I think that is going to make their currencies lose value versus the dollar. So they're going to have inflation in their local currency terms, and they're going to have deflation in dollar terms. And that's going to create this crisis, which is going to, I think, push money into the dollar. And so I don't know if that helps explain the whole inflation versus deflation, or the
no, it does.
The debt crisis. But I think that is the ramifications, and that is the side effects of a global debt crisis. Because I don't think it's just a U.S. dollar debt crisis. I think euro debts, yen debts, yuan debts. I mean, it's a global phenomenon.
Yeah. So you've already been super generous with your time. I guess just last question here before we depart. But how, if you're you are an investor, you manage money on the behalf of other folks.
Yeah.
I mean, how do you prepare folks like this? Like, how do you guard against, I guess, this worry that you have of the debt deflationary cycle?
Well, so there's a couple ways that we've prepared for it. First of all, for my clients, I customize everything to them individually. So none of my clients have the same portfolio. Now, all the portfolios have similar features because I'm the manager and my belief system is going to show up in there. But some clients may have a business that pays them a very good income, and so they don't necessarily need fixed income or some kind of a yield generating asset to provide their income. Other clients, maybe they don't have that business. Maybe they just have the cash that they've given me to invest, and we've got to design a system that works for them to provide for their living expenses. So we may allocate theirs a little different. But what I do for everybody as a roadmap, and again, nobody does this exactly, but there's this thesis called the permanent portfolio, and it goes back to the 70s. This guy named Harry Brown wrote this book on the permanent portfolio. It basically is a combination of 25% cash or fixed income, 25% equities, 25% real estate, and 25% precious metals or hard assets of some kind. And so this kind of became popular in the 70s, but the reality is very, very wealthy families that have had money for generation after generation after generation have always done some version of this as well. They have land, they have art, they have gold, they have businesses, so they have a little bit of that. And the reason they do that is because you're prepared for everything. If you did this portfolio that I mentioned to you a minute ago, 25, 25, 25, 25, just those four asset classes, and you did it for the last 60 years, you would have only lost money, I think, on 5 or 6 years. The most you ever would have lost was 12%, and you would have kept up with the S&P 500. Now, if you did the S&P 500 over the same time period, you would have had, you would have lost money like, like 12 or 15 years, so half the time you would have lost money. Many of them would be down 20% years, down 30% years. And so the volatility is off the charts. And if you do this permanent portfolio, you're ready you work for war, revolution, booms, economic expansions, busts, inflation, deflation. You'll get through anything. And so I always use that as the core to say, this is what we're going to build it around. And then the way that I plan for this debt crisis is because I can't time it perfectly. And because I could just be completely wrong, is I've said, if this happens, the knock-on effects will be so severe that there's a number of asymmetric opportunities out there. And so we basically designed a fund that we have said this should be 5% of your overall portfolio. In some special cases, because of some special circumstance, maybe 10, but certainly not more than 10% of an overall portfolio. And the idea is that if what we think is going to happen happens, the 5% allocation could literally go up 5, 6, 7 times. Now, I'm not saying that to be dramatic. I'm saying those are the types of trades that we're doing in there. And so if that happens, the 5% can become 30% or 35%. Well, that means if the 95% in traditional assets gets cut down by 30 or 40%, and now it's at 60 cents, well, the 35 cents of the hedge added to the 60 cents of the traditional, your portfolio is still pretty much whole, right? So it's a hedge against these really bad outcomes. And if we're wrong, which we have been, we could lose half our money. And to be honest, we have. There's been a big drawdown in these positions because of it hasn't happened. But the other 95% of the portfolio that is in traditional assets has grown a lot. Their businesses have grown. The equities that they own have grown. The real estate that they have has grown. Gold has done well. So it's more than offset the 5% that's allocated to these asymmetric opportunities. Now, if I had a better timing mechanism, perhaps I would allocate differently. But the way I've explained it is, this is a 5% allocation. You got to be prepared to lose it. Maybe it takes 3 months, maybe it takes 3 years to play out, but at some point we think that this is going to be a good insurance policy to have. So that's kind of how we've approached it. Maybe there's a better way to do it, but that's the way we've tackled it.
Awesome. That sounds great, Brent. Thanks so much, man. You've been really, really generous with your time. If people want to find out more about you, Santiago, kind of the work you do, what's the best way to do that?
Sure. You can always you can send me an email. You can just go to santiagocapital.com. It's got my contact information on there. I'm very very involved in Twitter, I guess, for lack of a better word. So Santiago AU Fund, or you can just search for Santiago Capital and you can shoot me a DM or respond to one of my tweets. I do a number of shows like with Blockworks and some other platforms. So, I actually hate saying this because it just sounds so kind of silly and ridiculous. But if you actually go on to YouTube and type in dollar milkshake, which is kind of what I've titled my theory, you'll get a number of different links that you can watch and learn more about kind of how I think things are going to play out.
Awesome. Well, thanks a lot, Brent. This has been a ton of fun. We'll have to do this again sometime soon.
Anytime. Thanks again.